But you have to know, what are you willing to risk, right? You don't have to take big risks, but you have to have a plan and you have to have a support system. So if you're doing it yourself, maybe a family member can give you encouragement and tell you, hey, you have to put your money in your IRA this year or whatever. If you're not, that's something that we do, certainly as a firm, but you need some kind of a feedback loop there. You need someone, if it's not yourself, reminding you, okay, we need to take care of these things. All right, so getting really basic here. You now open an IRA, you've assessed your risk, and there's all kinds of things you can invest in. The market, large cap, small, middle cap, U.S. foreign markets, capitalization. And I don't assume people know what that is, but if capitalization is simply the value of a firm. If it's determined by the number of shares out there times today's share price, and that's what a firm's worth. So a small cap firm is a smaller company worth about $300 million to $2 billion. That's considered small. 2 to 10 billion is a middle cap, and 10 billion is companies like IBM, Apple, Google, all fall in that category. But you have lots of choices. All right. Beyond that, all those choices fall into 14 different sectors of the economy. So, which sector should I invest in, John? Well, we consider ourselves somewhat expert, but no one's really an expert on which one is going to do the best this year. I remind people that in 2008, when the financial bank sectors started melting down, up to that point, in the first half of the year, finance was probably the best, the financials did the best of anything. Then all of a sudden they melted down. So if you were just in those, you probably lost half your money in that. So you need to be spread out across all these things. And I can't drive it home more than with this chart. I don't know if you've ever seen something like this. This is a busy chart, you probably can't read it. And that's somewhat by design. My background is, I think I mentioned to you, I was a chemistry major, chem and psychology in college. When I got an MBA, the light bulb went on, like I said, but even in the finance industry, they put together charts. And this one breaks down all the sectors. And all that you should take away from this chart is, if you follow any color, and these are based on, some of these things are large cap stocks in blue, I think the orange ones are emerging markets. You have a breakdown of all these sectors and types of investments I talked about. But if you just follow one color, I don't know, so let's take the red one. Does that show up pretty well for you? I mean, the fact that these go back 20 years now, and they say which sectors did the best. And here in 1993, it was the absolute worst. But for 95 through 98, it was the best. And all of these things have been the best and the worst at times. And even the experts can't predict which is going to be the best next year. You just don't know. And so at the end of the day, you really should have some exposure to all of these things. And most portfolios don't. They try and guess at what's going to be the hot sector. Emerging markets up there, the foreign investment had a nice 5-year run up there. Last year was the absolute worst. Things like bonds that are not exciting. You notice in 2002, 8, and 11, those are some bad years. 2002 and 8 both had some recessions in them. Those turned out to be the best. So you can make educated guesses at what you think is going to do well next year or this year. But the fact of the matter, the truth is, you should be invested in all of these to some extent. All right. In addition, even within an IRA, you can have real estate related investment. We sell some, as a matter of fact, within our firm that are appropriate for an IRA. You can also have precious metals. You can't hold physical gold in there, but you can have exchange traded funds that are tied to the price of gold. So you can have exposure even to these things, commodities, things like wheat, corn, coffee, whatever. You can have exposure to those too. And I recommend having all of these things to some extent. I mean, you don't want to put all of them in that basket, but even up to probably combine these three, maybe 10% of your portfolio should probably be in those things. And bonds, again, a lot of people don't understand that bonds typically are for, for if you're looking for income from your investments. Most people, especially younger people, tend to be looking for growth. But there's a place, as you saw in those bad years, bonds outperformed everything in the market, foreign or otherwise. So while they're not exciting investments, every portfolio should have some. And then, of course, the closer you get to retirement, probably the more you're going to want. So now let's talk a little strategy here. I grew up in Ann Arbor, big Michigan football fan. When I was a kid, I started going to games. 7 years old, Bo Schembecker was the coach, and I don't know if you probably weren't even born. He was criticized because he was really conservative with his play calling. He didn't like to pass. And you ask him, the reporters would ask him, why don't you ever pass the ball? And he said, well, because when you throw the ball, three things can happen, 2 of them are bad. You invest, 4 things can happen, 2 of them are bad. Right? How do we manage that? Well, you need to set parameters, and you're thinking about buying a certain stock or a mutual fund. You should ask yourself, once you figure out from the many things I showed you, from you're going to buy something in the large cap arena or the small cap arena, or whatever. Once you decide what it is you're going to buy, you need to figure out what price is reasonable to buy it, right? And I'll tell you, most Americans are very good at finding bargains. So people aren't that bad at figuring out when to buy. What's really difficult is when do you sell. And you need to set targets. Okay, and there is a technique called stop loss selling. You ever heard of that? Okay, I'll give you an example of it, and we'll try and tie this in with the strategy. In 2008, when the markets were tanking, the market fell by 50%. That summer, and one of the strategies you may have heard is when times are bad, you want to buy advice. You want to buy cigarette stocks. You want to buy Anheuser-Busch. People are going to try and drink their sorrows away, so beer sales should go through the roof. People go to casinos, so gaming stocks did well. So I studied a few casino stocks and I bought them, and it was at $3.76 a share. I thought that's a great point to buy it, right? And I did. And I'm in industry, so I knew what to look for. But I'll be honest with you, I didn't know when the right time to sell was. I didn't know that it would necessarily go up. So, Johnny, this is somewhat speculative. What can I do to protect myself? Well, how can I manage risk with this? And the second I bought it, I said, well, what am I willing to lose? And I figured I could stomach about a 20% loss. If this dropped by 20%, get me out. Right? Well, even though I'm at my desk all day looking at these things, I can't watch an individual stock all day long and know every trade that's going on. So the second I purchased it, I put in an order to sell at 20% below what I purchased it for. Now, if it never gets down that low, that's great. It just sits there and keeps going up. Well, what happened to this is it went up $5 and $6. It eventually went up to $16. I didn't get out there. I didn't. But what I did is I canceled that $3 sell order, and I kept moving it up as the stock went up. And it doesn't cost anything to do that. I mean, you can do that online at Fidelity, or wherever you're going to go. You can do it yourself that way. We also, of course, can do that. And I thought at that point, well, Jesus, sorry, $16. What am I willing to lose now? And I said, well, let's just take. If it falls by 10%, I may be out on the golf course. I may be on vacation. I don't know, but I'll get out of that. And the market did. I mean, last summer I think it fell, and I think it's at $10 now. But I got out at $14 because I opened $14.40 because I wasn't watching. You took all the emotion out of it. That's something you can do, with anything you purchase. You can turn around and put an order to sell to protect your losses or to protect your gains.